Let's talk markets and where to put your money to work right now. Joining us is Mona Mahajan, Principal and Head of Investment Strategy at Edward Jones. Mona, a lot has been made of kind of the muted response to the news surrounding the Fed, what the president can do regarding Lisa Cook's job. Were you surprised by the market reaction? And if it doesn't react, what does that tell you about how much the market effectively cares?
Yeah, look, I think the market does care about Fed independence. We know, first and foremost, the Fed is a body that protects long-term economic stability. And if that is disrupted in any way, we could see market volatility, rate volatility. In fact, yields could start to move higher rather than the lower goal that the administration has. All that being said, the Fed Board of Governors, they do have some scope of responsibility, including discount rate, including reserve requirements. But the broader monetary policy is still set by a 12-member FOMC board. Very difficult for one or even two members to sway that, even if it is the Fed chair himself.
So you don't buy this notion that by even going this route, by firing her over a post on Truth Social, that sends kind of a shockwave to the rest of the members that, you have to either get in line or deal with something that Lisa Cook is doing, that it's not some sort of signal to everybody else?
Yeah, I think the American people still have faith in the overall process and the system, and that Fed independence will remain intact in some way, shape, or form. And I think that is the bottom line in terms of what we're seeing in the market reaction as well. And we are hopeful that over time, that is kind of the direction of travel, and the administration realizes that is probably the best for all parties involved.
So looking ahead to today, we probably the most important day of earnings season, at least in the last couple of years, has been Nvidia's earnings day, which is after the bell today. How do you see it all playing out? Expectations are very high. It has a strong potential to move the market in either direction. So what are you advising clients going into today's print?
Yeah, look, Nvidia is always a bellwether for the AI technology trade. We expect very strong results. Their revenue should exceed 50% year on year. Of course, that's slowed over time from triple-digit gains to down to high double-digit gains. Nonetheless, we think the AI technology story is one that investors have to have exposure to. We know probably a secular theme, 3 to 5 years still in the forward outlook. When we think about it, of course, right now, we've seen all the gains in the infrastructure players of AI, whether it's semiconductors, whether it's the data center players. We do expect over time that will broaden to some of those sectors that benefit from the productivity gains, whether it's financial services, healthcare, industrials, and manufacturing. All should participate over time. And by the way, if the Fed is cutting rates, some of those sectors may play some catch up as well.
Where do you find the sort of sentiment for most of your clients at the moment, and you guys internally? Is it overly stretched or not particularly?
Look, we've had a nice 30% rally in the S&P 500. A lot of our clients, advisors are asking, is there going to be a pause upcoming? And we are headed into a seasonally choppy, historically September and October can see some volatility. All that being said, I think many realize that as we head into 2026, we see a couple of positive momentum factors. One, of course, we talked about the Fed potentially moving rates lower, even gradually. We also see the tax bill that's just been put in place having a little bit of fiscal thrust. And the third factor I'd mention is the cash on the sidelines, whether it's money market, cash-like instruments. All of that might come into play, especially if in 12 months from now rates are a bit lower. So we do see this possibility that we could get this reacceleration in 2026.
At what level are you looking for some of that cash sweeping phenomenon to reverse itself and move back into the markets? What rate level usually allows that to happen?
I think if the Fed does move rates more towards a neutral level, call it 3.5% or in that range, you could start to see some actual movement. Historically, though, where we are now, 4% plus, pretty good yields versus, the last 10 years or so. If you're in retirement, near retirement, you're getting a good rate of return. But if you think of that at the 10-year Treasury level, you can lock in that rate now for about a 10-year horizon and have that potential for price appreciation there as well.
In terms of rate levels, what level, if we do see longer rates rise, what level spooks the equity market?
Yeah, look, historically, it's been around that 5% 10-year that has been a kind of a hindrance for the equity market. But all that being said, we do think that the 10-year is likely to remain range-bound here. It's been in this kind of 4.5% range unless something dramatic happens in terms of whether it is debt or inflation. But for now, we see both of those, especially on the inflation front, likely remaining in a contained range.
Given what you mentioned with regard to 2026 and the potential for rate cuts, the potential for some fiscal stimulus from the One Big Beautiful Bill filtering through into the economy, are you worried that inflation may pop back up again? And then what do you do from a portfolio allocation standpoint now in anticipation of that?
Yeah, look, I think even the Fed has acknowledged it's still caught in this, between a rock and a hard place. Inflation, whether it's tariff related or stimulus related, there is a potential for it to move higher. Now, from a tariff perspective, the Fed has at least indicated a good base case scenario is that perhaps there's a one-time shift higher in the price level of goods, and from there we should see some stabilization. So we also are in that camp that we could see inflation rise, in this 2.5%, 3.5% range now. Maybe it goes a little bit past that, but we don't see it returning to this kind of 8-9% type range we saw post-pandemic. So still hopeful that the inflation rate is in this contained range. Over time, we see it moving in towards the Fed's 2% target, which is the good news. And so I think despite near-term inflationary pressures, we think the Fed is focused on labor market and, of course, 2026 looking better than expected.